In today's program, we delve into one of the most fundamental and strategic decisions facing any entrepreneur committed to positive social and environmental change, the selection of the appropriate legal structure for their impact-driven enterprise. As the global movement toward sustainability accelerates and the call to build a truly regenerative economy grows increasingly urgent, entrepreneurs and investors alike find themselves navigating complex legal landscapes, choosing between entities such as benefit corporations, low profit limited liability companies, L3Cs, cooperatives, and nonprofits is not just an administrative detail, it's a critical determinant of how successfully a venture can scale, attract aligned investors, and preserve its core mission through all stages of growth. And to guide us through these pivotal conversations, we are delighted to welcome Mark Chasson, a seasoned attorney, accomplished serial entrepreneur, strategic advisor, and Impact Entrepreneur Magazine correspondent. Mark has personally participated in more than $500 million of financing dedicated to accelerating ventures committed to regenerative practices and systemic change. His deep expertise expands not only the intricacies of legal structures, but also the broader ecosystem of regenerative innovation and community transformation. Over the course of our conversation, we aim to uncover insights from Mark's recent article that he wrote for us. It's called Choosing the Right Entity for Your Impact-Driven Business. Here in the chat is that link to that article again. Hopefully, many of you have already read that. Exploring how the interplay of governance, legal structures, funding sources, and mission alignment can either amplify or constrain an enterprise's potential for lasting impact. We'll also examine, hopefully, some case studies of entrepreneurs. Hopefully, those case studies will come from many of you. I've got a few lined up. Entrepreneurs who are facing critical entity choices, considering the implications for accessing different types of capital, from specialized impact investors to mainstream financiers, and to discuss how ventures can structure themselves flexibly to adapt to growth and evolving impact strategies. So we look forward to your active participation, your thoughtful questions, and candid dialogue as we collectively deepen our understanding of how the right entity choice today can position our ventures to drive meaningful and sustained change in the future. And now it is my pleasure to introduce our featured guest. Mark Chasson is an impact entrepreneur correspondent, combines his experience as a lawyer, serial entrepreneur, strategic advisor, author, and fundraiser, who has participated in over $500 million of financing to accelerate the multi-trillion-dollar regenerative economy. The regenerative economy devoted to the thriving of people and planet will be the largest and most enduring economy in history, according to Mark. Throughout history, the two most impactful levers of influence and change on humankind have been, one, the environments in which we live, and two, technology. And as CEO of Transformative Inc. and Awe Global, Mark is committed to developing regenerative communities that positively transform the environments in which we live, work, learn, and play and consume, and advancing living systems innovation, technologies, and regenerative entrepreneurship to create an economy, the regenerative economy, and positively transform our world. Mark, welcome to our deep dive conversation.
Thank you, Lori, and thank you so much for Impact Entrepreneur Magazine, all that you are doing to advance the regenerative economy and to really create good in the world. And also thank all of you for being here today for this discussion and supporting in the ways that you do the betterment of our world for people and planet. I would just like to start by saying often when I'm in these impact conversations, we talk about sustainability as the rallying cry for improvement in the world, but really Sustainability is a slower way to die. It's a do no further harm philosophy, whereas regenerability is actually a do good philosophy. And if we just stop doing harm, we would just slow down the rate at which we die. We actually have to be proactive and to create remediation of the damage that humans have done and take a proactive approach to really providing new energy, vitality, and resilience into our systems, whether it be the ecosystems of the planet or our society. And so I'm really focused on helping the entrepreneurs that are doing this regenerative work to succeed, because the more they succeed, the more they scale, the more rapid we can actually accelerate that regenerative economy. And one of the things that I find is that there's conflicts in our world today between trying to do good and profit. And a lot of people see these things as separate or exclusive in some way, and they aren't. I believe truly that we can do good, and especially when we're responding and providing solutions for our largest and most existential challenges, that we are able to actually address these massive challenges and provide huge opportunities for profitability and impact. Over my years, I've seen often the impact investing space giving black eyes to investing. And what I've also witnessed is that many of the impact investors, they talk a really beautiful game. Oh, I'm the hero. I'll take lower returns over longer periods of time with greater risk. Aren't I so wonderful? And yet they really aren't truly investing the bulk of their monies into impact. Most of them are investing in impact funds of public companies that include in their portfolio things like Microsoft and Pepsi and Apple. And even I look at AutoZone, for example, which is considered an ESG company. They really haven't done much with their supply chain or efficiencies or lowering the amount of fossil fuel they burn, but they put a couple of women on their board. Now, I think inclusivity and actually, being gender and colorblind is a wonderful thing. But let's really face where the impact is happening within sustainability and how we can move impact investing into mainstream and through the things that are doing good and the businesses that are doing good to actually provide market rate risk adjusted returns that match or exceed that which is being made in investment in more conventional and extractive industries. And I believe that is possible. And one of the things we're here to discuss today is not only how can entrepreneurs that want to create impact and true wealth for the world, the environment, the planet, and themselves can form the right entities and make the right decisions and get to a place of capital readiness where their businesses truly do meet the KPIs and metrics of many of the traditional investments and have the ability to attract more mainstream investment. So here we go. Anybody have a question? Or Lori, if you want to kick it off, we can start with you and then go from there.
Yeah, thank you, Mark, for those framing comments. Yeah, as we move now into the core of the discussion, I'll say that when you are called upon, before proceeding with your question, you're welcome to share your own reflections on the topic. If you do, we ask for your consideration for others with questions in the queue and keep your comments and questions as concise as possible. If I feel like you're taking a bit too long, I will gently ask that you finish up and get to your question. And there's no offense meant by it. I'm just trying to keep the proceedings moving along and letting as many voices be heard as possible. Again, please use the raise your hand reactions. It's in reactions, the raise your hand feature. Or if you're not comfortable speaking your question, write it in the chat. I will prime the pump with one or two questions to start while you think about what you want to share with Mark and ask Mark. Mark, just kind of broadly speaking, in your experience, what is the single most overlooked factor when entrepreneurs select a business entity to support their impact mission?
Well, in many ways, this is a two-pronged question because one, there is supporting their impact mission. The other is actually supporting their business, their core business, and hopefully their core business is their impact mission. But what I found is that entrepreneurs often elevate form over function. One of the first things they do before they've even started to really understand their business or to articulate their mission and purpose statement is run off and form a Delaware Corp or a Delaware LLC without really understanding why they're doing an LLC or a corporation or going to Delaware. And often I found that um, and we could start by saying this, a lot of the more esoteric mission-oriented entities like the PBCs or public benefit corporations, the L3Cs or cooperatives are sort of in rarefied air. And if you need to raise money, there are other ways that you can use a more mainstream entity approach, but provide governance structures and trust structures and share structures and charter documents that actually preserve the mission and purpose of the organization while also allowing the company to appeal to mainstream capital.
Mhm. Just kind of further to that, then, how might governance structures differ significantly between a benefit corporation, an L3C, and a cooperative in terms of maintaining mission fidelity as an enterprise matures and faces pressures from market or investor interests?
Well, I find that PBCs have gained a lot of adoption. Approximately 41 states have adopted legislation for PBCs, so they're pretty well known. And basically, it's a corporation with a public benefit purpose that's articulated in its articles and its charter documents, like its bylaws. It has also some reporting requirements that normal corporations or C Corps don't have. L3Cs, I tend not to be a big fan of them. And the reason is that they're only adopted in about 12 states. Don't quote me on that, but the adoption is pretty rare. And the only, I would say that if you're looking at the most, uh, the leading states for uh, corporate incorporation, it's Delaware, it's Nevada, it's Texas, it's Florida, and Wyoming. Now, out of those five, only Wyoming has adopted an L3C legislation, but interestingly enough, has not adopted a PBC, whereas the other four have adopted a PBC. So sometimes when you're looking at an entity, you have to look at really what is the mission, the purpose of the entity if you're an impact entrepreneur, and what entity structure will actually serve the function of the organization rather than just the form of it. And so with PBCs, it's really a corporation with a public benefit purpose. The L3Cs are really just a limited liability company with a social and public benefit purpose. The problem I found with L3Cs is that because they're low profit and they have elevated the social, environmental, or governance mission over that of making profits as opposed to a PBC, which is we're going to equalize and balance these things. Many mainstream investors and even impact investors won't invest in an L3C. Furthermore, because they are not tax exempt, you're not going to find the donors and the foundations that would generally make investments into a nonprofit investing into an L3C. So personally, I'm not a big supporter of L3Cs. And another form where that really supports the mission and has democratic ownership and voting are cooperatives. However, cooperatives, while almost every state and possibly every state has adopted legislation for cooperatives, they're very limited. And most states limit it to agriculture and or utilities. Some have housing cooperatives, but their purpose of cooperatives is very limited. Some states actually require the cooperative to be an unincorporated association. So when forming a cooperative, again, I would say it's not really a mainstream entity structure that you would normally use. But let's say that you have an agricultural concern and you're doing regenerative agriculture and you wanted to create a cooperative for local small farmers to share in having equipment and resources and determining what cash crops are the best for that bioregion, setting up some kind of a collective bargaining and distribution arrangement so they have more power in the supply chain when they sell their crops to the supply chain, potentially even creating value-adding processing in the cooperative. Those would be the typical types of businesses that you would see forming a cooperative. So in today's discussion, I think it's going to serve our time best to look at potentially how can we use corporations, including PBCs, LLCs, LPs, as the primary structure that allows a company to gain investment and to scale. So, for example, if a company can't scale, it can't raise capital, it actually can't grow because it can't raise capital, how much impact will it have? Largely, the impact of a company is based upon the scale of its products and services, the scale of community and social impact, and the number of employees that it retains and hires. So, how can we scale impact and utilize more of these mainstream structures, but have governance and stock structures in place that actually provide for the preservation of mission and purpose?
Mhm. I hope that we can dig into as much of that as possible. Before we get maybe into some of these details, I would like to ask another general question about kind of just emerging trends right now that you're seeing, or innovations in legal structures that might not be on people's radars. Is there anything new emerging that's interesting to you, that might become a prominent thing over the next decade and profoundly impact entrepreneurs and their enterprises? And also, I don't know if how much focus you spend on legal structures that are being pioneered or developed in other countries like the UK or others around public benefit, and whether there's anything particularly interesting that you'd like to highlight for us right now, kind of at this broad level.
Well, as many of us know, Europe is implementing disclosure and reporting requirements for ESG so that companies can no longer be greenwashing and making statements that truly aren't supported by facts. I think that we're seeing the carbon markets being transformed to be much more efficient and credible in their reporting. Although I really believe that humans do cause change to our climate, but I also feel like it's a red herring. And if we really moved away from this idea of climate change, does it exist? Does it not exist? Do humans cause it? And really focus on a core question. Is the contamination of our air, water, soil, and food good for people and planet? No. Let's take care of that. And quite frankly, if we take care of that, I believe we'll also take care of many of the climate change issues. So I would like to, and within the regenerative framework, those are some of the core areas. It's the clean and renewable energy, materials, chemicals. It's transforming our supply chains, especially our agriculture and food supply chain, which contributes so much to environmental degradation. But to answer your question, there are some interesting things that are bubbling up. One, that there are with blockchain, these, DAOs, and that is something of a new kind of structure. And when new structures appear, the regulatory environment often is lagging behind innovation. And we're seeing that these are somewhat new structures. And unfortunately, there are very few actual pure DAOs. maybe Bitcoin being the only one, because many of them are actually controlled by proof of stake or proof of work, and who has the most money usually controls proof of stake and proof of work. And we've seen a lot of pump and dump happening and less than desirable integrity inside of the crypto space. But I believe that the regulatory environment and some hybrid between centralization, ethics, and integrity will actually allow blockchain and blockchain ledger to actually reduce much of the corruption and lack of transparency that we currently have. So I think that is something to consider as we move forward. And how, again, can we create governance in the DAO that is transparent and that actually functions to serve the regenerative entrepreneur and businesses? So that is one that I think is something we should keep our eyes on. I would say that also we're finding that there's these perpetual purpose trusts where you can create a trust and you can have, say, a for-profit company, but you have what's known as a golden share, or many of us are familiar with supermajority voting stock that can be voted to ensure that in perpetuity that purpose and mission is adhered to. So there are ways to structure existing fairly conventional entities to actually adhere to their mission and their purpose. I would say the hybrid organizations are also something we should be looking at. I don't see much new on the horizon as far as new entity structures, but I do see that there are ways to combine the entity structures that exist. So, for example, we could use a hybrid structure where you form a nonprofit and the nonprofit forms a for-profit subsidiary. There's also ways that we could do a Newman's Own type of model where the for-profit company agrees to give all its profits to a nonprofit. There's ways that we can also set up a combination of cooperatives, trusts, and for-profit companies, nonprofit companies, so that each entity within the ecosystem is best served by the entity that it does incorporate for its purpose and its mission.
Mm-hmm. Thank you. That was really helpful. I'm going to prioritize hands raised. I've got a whole slew of my own questions. There's so many things I'd like to talk about here, but I see Richard has his hand raised, so we'll start with Richard, and then we'll go to Chris, and then Denise. Richard, can you come off mute? There you go.
Yeah, okay. Thank you, Lori. And Mark, congratulations on all your success with the 500 million. I wanted to just mention a couple things about what we're working on, to give you a little background, and then ask a question related to pathways forward. So I've got a company founded in 1993 in Massachusetts called Solus Inc. It's got two sides of the business. We are an investor in, an advisor to our Honduran subsidiary, Solus Honduras. We're focused on delivering solar photovoltaic solutions for off-grid and more recently grid-tied. The off-grid was the only viable application when the prices were higher. Now it's viable to connect in with the grid. What we've worked on there is building a local enterprise. You know, it's a business model it's actually hybrid, whereas a scale of 1 to 4 million a year in sales, and it's a hybrid because we have partnerships with a couple of nonprofits, one being Kiva, KIVA.org. And so we've got an ability to finance our customers through crowdfunding. And that's a nonprofit that's delivered over $2 billion worth of loans. So we can obtain our funds there and provide loans that are fairly low interest in Honduras. But the other side of Solus Inc. business is consulting, which I call more or less, like, based on what we've learned, kind of spreading the love, getting the ripple effect. And so we do advisory work. We assisted, well, starting in 96 with the Green Bank. So they'd set up a branch that was delivering basically renewable energy technology. We assisted Selco India in India, which has become a fairly large scale and now has a foundation. We assisted the World Bank in a number of countries. So the way we're structured is how I want to ask about what I'm seeing as two paths. So Mark, it seems like your path is being just some of the words you've suggested as related to, let's say, getting growth to scale in the particular company. So that company, that entity gets very significant scale, kind of like a venture capital approach, building if you will, if you can get a hockey stick, or really it's about getting scale in a particular legal entity by its ability to attract a lot of capital. That's kind of path number one. Our path is perhaps based upon a little different view on that. Micro and small businesses in a country like Honduras make up perhaps 80% of all employment. A lot of the companies are family companies. So another path to growth would be many, many more small enterprises, local enterprises, family-owned enterprises, enterprises that can last maybe through several generations of families, which is what we typically see in a place like Honduras, but other developing countries as well. So the path to growth and the types of entities and how you structure this would be perhaps more related to how to replicate, how to kind of encourage and get many thousands of small enterprises as the growth path, but each one of those has different owners. It's not, like one, huge company. And so my question with you is, how do you view those different paths? I got a sense that you might be more on the path one, which is how do you get, a lot of capital into a company to get, very significant scale. And I'm talking more about companies, probably the range of $1 million to $4 million worth of sales, viable, profitable, but, local. And so can you help me better understand how you view those two paths and your insights into our potential to really expand regenerative companies to help us get on a sustainable path, but a more regenerative path.
Yeah, sure. Thank you for that question and the foundational background from Saluz and what you're doing. So I believe there are many paths to creating the regenerative economy and for regenerative entrepreneurship. Not every single entrepreneur wants to be a public entity or have a large M&A. Some, as you have mentioned, Richard, are very interested in doing good, staying small, staying local. And there's nothing wrong with that. And my sense, though, is that, to your point, if you have one small farm, and that's all you have, you'll likely be struggling. If you can either acquire many small farms and help many small farmers, and you can have an organization that, say, is a development company or a funding company or a consulting company that actually does go out and create this weave between small businesses to help those small businesses grow and to provide the services, the equipment, the data, the distribution that they need, then you can service these smaller entities and have a significant impact. And so I'm looking at how can we have impact? How can we accelerate and exponentiate that impact? That's really the key. And many small businesses can have a big impact if they are able to find that interconnection and create exponential relationships between them. I'm not sure that answered your question, but I hope it did.
Well, I will say, just to continue the dialogue a bit more, it's part of it's reflecting on kind of how ownership tends to be and the majority of employment in a setting like Honduras, where you really have mostly small enterprises delivering. So if we don't transform those small businesses to regenerative and don't kind of use that natural tendency, I just see that such a significant employment and delivery of everyday goods or whatever will transform towards more regenerative. And so that it's kind of going with that understanding in terms of looking at model. And so I agree with what you're saying is kind of create a structure that can support that, whether it'll be, consulting or engagement with NGOs that can support small businesses to really get that to scale. So, I think both paths are very valid, and I just wanted to throw that on the table for your input, how you view that. I think I tend to agree with what you're saying. You're trying to catalyze the replication and the transformation of many small businesses, I think is an important aspect of what we're going to have to accomplish, given kind of the natural way things grow in that setting.
I think that we should, Mark, maybe you can, if you have more thoughts, you can maybe weave them into other things that you will say as we get to some of the others, but we have 6 people already with hands raised. So I'd like to get on let's see, we're going to go Chris, Denise, Caleb, Jay, Jack, Marie, in that order. Chris.
Great, thank you. I'll make this mercifully short. Mark, thank you again for your wonderful insights. I'm curious if you can expound a little bit more about the hybrid organizations, because I've found it difficult to avoid conflict of interest, specifically when you have an NPO that then wants to start a for-profit. Obviously, the NPO directors cannot participate as officers in the for-profit without conflict, and vice versa. I'm curious if you have any solutions for that.
Thank you, Chris. Wonderful to see you again. And by the way, Chris Fury here is also just incredibly knowledgeable about structures and very, very innovative financing mechanisms. Thank you for being here, Chris. And I would say that is one of the big issues inside of hybrid organizations, where you have an executive director and a CEO, and money is flowing back and forth between a for-profit and a nonprofit. And what I would say is that you can actually create governance documents that really are very clear and limit the authority to avoid conflicts of interest in hybrid organizations. Generally, too, a nonprofit doesn't have shareholders. The beneficiaries of a nonprofit is society, it's the public. And so understanding that, in a sense, the public owns your company. And if you're taking money out of the public's pocket and putting it into yours, big conflicts, and likely it's going to be illegal, and there may be you may be charged with some violations and fraud, etc. So it's really important to look at these hybrid structures and how money can actually flow from the for-profit to the nonprofit. And what I found is that there are and I'm not a tax attorney, and I don't claim to be a specialist in nonprofit organizations, but I know enough to be able to know when I need to get that kind of advisory. And what I would say is that generally you're going to look at taking anything that is tax deductible, large operations and salaries and even CapEx, and putting it into the organizations where you can actually deduct those expenses as tax deductions. In the nonprofit, you want to be scaled back, and as many of you know, in a nonprofit, you can only have so much. If you want to get foundation funding, you have to have a very limited operating expense, a very limited marketing expense. You have to put most of your money into the actual projects. Instead of showing maybe financial returns, you're showing social returns or environmental returns and finding ways that you're actually promoting but also having KPIs and metrics to substantiate your impact in a nonprofit. So I believe that you can do it, but you want to make sure that you have different people running the nonprofit than you do running the for-profit. And you can put a lot of things into the for-profit. For instance, there might be you might develop technology in a for-profit, and then you give it to the nonprofit, and the nonprofit then becomes an IPCO or IP company that is licensing that technology. You could basically have the nonprofit managing a real estate portfolio, and anything that has to do with schools or agriculture or recreation can be held by the nonprofit, and it manages the portfolio with a very small staff, while the operating expenses of the businesses in that real estate are going to be for profit. So I think there's ways where, one, you create the governance documents, you ensure through those governance documents and SOPs that you are not engaging in conflicts, and whenever possible, you make sure that any assets or money is flowing in the direction of the nonprofit. Now, having said that, there are going to be times, however, where a for-profit has specialized knowledge. And the best way to handle that, if you want to hire your nonprofit and take money out of the nonprofit and give it to the for-profit, you should do an RFP and show why that for-profit had specialized knowledge, was more reasonable in pricing, could do the job better. And so you want to make sure that those conflicts are well documented.
Thank you. Let's move right on to Denise.
Hi, thank you. This is Life to Launch. We are a hybrid, so we have the nonprofit and the for-profit. We're in ed tech. So pre-seed's been my money, and now that I'm moving into pitching to VCs, my question is around the security type, validation, conversion discounts. Like, I'm a little lost on being very protective of I don't know, I just organized it as an LLC for now and I know it might need to shift to a C or a PBC, but any advice on security type that gives me the most flexibility to keep it really supporting the social enterprise work that we're doing?
Sure. Thank you, Denise. And I'd love to learn more about Life to Launch. But to answer your question, being an LLC, you don't have stock, but you do have equity. And unfortunately, the IRS is a little murky sometimes on its regulations concerning LLCs versus corporations. So, for example, in a corporation, issuing a SAFE, a simple agreement for future equity, doesn't create the murkiness. However, inside of an LLC, it does. So if you're going to raise money in an LLC, I would generally recommend that you use a convertible note structure, and especially early on. You don't want to have to do, large shareholder meetings, but in an LLC, you generally don't. And you can set up your operating agreement in a way where it's not member managed, it's manager managed, which is much more efficient. And that way you don't have to go to the members every time that you have some extraordinary event and get their vote. The other thing is if you use a convertible note, the investors are not yet equity holders either, and they have different rights. In some ways, as a convertible note holder, the debt holders have priority over equity holders in the event of any kind of a liquidation. So you can also create structures within those convertible notes that make it appealing for early investors. So I'm going to ask you a question, and it's a very simple question. Let's say you're raising $5 million at $100,000 minimum investment. And all things being equal, would you rather be the first money in or the last money in?
My money, or?
You're an investor.
Oh,
And Denise is pitching me for
right.
launch and raising $5 million at $100,000 minimums. You know, at me as an investor,
Mhm.
I'd rather be the first money in or the
Yeah.
last money in.
I would say, I don't know. I'm just guessing
And,
first.
and this is
Yeah.
this is the interesting thing. I mean, I've asked this question to so many entrepreneurs, and they say first money in. I go, why? You know, if you're last money and you've got $4.9 million raised, you have less risk and you're getting the same stock as the first person that took all the risk, the first 100,000. So you want to be last money in. And this is investor psychology. So why does it take so long? And people do these, you know, I'm going to do a $5 million note at 20% discount. And what happens is everybody waits to be the last money in. So how do you create that FOMO, that urgency that doesn't exist for investors? And so I recommend a tranche convertible note. Let's say, again, we're using an example of 5 million. The first 500,000, you may want to offer a 40% discount to next round. The next million, maybe it's 35%. Then you drop to 25% for the 1.5 million. And finally, the last 2 million gets a 20% discount. So what that does is it creates urgency and FOMO that doesn't exist for first investors to get in early and get a better deal for their money.
That was excellent. That
That's
was a great
awesome.
question.
Thank you.
Really useful response. Caleb, then we'll go to Jay and Jack, Marie, and Ashley has a question in the chat. So Caleb.
Thanks, Lori, and thanks, Mark, for all of the wisdom. And I'm sorry for not being able to come off camera. I'm on a large monitor, and if I were to turn on my camera, you would just see my profile, which is not as flattering as I want it to be. I've got a context and a quick question. I work at a business school at Stanford University with a number of students who are interested in building ventures that are both highly profitable and personally lucrative and also drive impact. As you might imagine, they are always curious about how they can seek out non-dilutive capital or philanthropic capital for their for-profit ventures. Who wouldn't be? And so we've done some research on this. I've published sort of a working white paper, which I'm happy to share with folks if they're interested on what we've been able to learn so far. But there's some gaps in what I've been able to learn, and I'm curious if Mark or if others in the community have insight here. I think the questions that I have primarily are kind of what are the use cases, especially if you're a foundation or an allocator of charitable resources, when you would feel compelled to donate philanthropic funds to a for-profit entity, and kind of how often is that happening or at what scale? I can't find any data on that, so I'm curious if there's anecdotes or trends that, Mark, you've seen in the field. And then sort of the second part, which we're really focused on, is what can entrepreneurs or companies do to make the case and to ready themselves structurally, procedurally, from a governance perspective, to receive and be good stewards of those philanthropic funds.
Okay. So I would say that not all non-dilutive capital is in fact philanthropic. To start with, there are many ways to get capital that is non-dilutive, and we saw, for better or worse, a lot of non-dilutive capital going into companies in crypto and blockchain, where they were not giving up equity, they were not giving up any kind of in-kind value in exchange except for the tokens themselves. And it was almost like the Fed printing money out of thin air. So, there are ways that you can use tokens and crypto for non-dilutive capital. There is inventory financing that is non-dilutive. When you set up your charter documents, you can have, while you might suffer equity dilution, you could set up management and control provisions where your management and control is not diluted with things like supermajority voting stock. With regard to the more philanthropic types of non-dilutive financing, I would say that foundations and donors looking for philanthropic investment are generally it's a flavor that's going into nonprofits. However, there are impact companies with program-related investments, And I think one of the areas where we're seeing a lot of investment that could be non-dilutive is from donor-advised funds, where, for example, like Kiva, even though it's a nonprofit, is making microloans, and it's being able to from the interest and the payback of those loans to regenerate its cash and put it into actually businesses that are for profit. So government grants can be used, but I would say that in many ways, it's you can use debt, you can use inventory financing, you can use factoring, you can use crypto, and there's plenty of different ways where you can engage in non-dilutive financing. The other thing is to expand upon my answer to Denise's question is how you structure your convertible notes. So with a SAFE, you can only really give equity, but in a convertible note, you can put provisions in where it could be paid back with cash. It could be paid back with crypto. It could be paid with in-kind products or services. And there may be different provisions that you can put into a convertible note that give you the flexibility to actually have non-dilutive capital in your organization. Did that answer your question, Caleb?
It did mostly. I think what I'll add is as context, and I'm mindful that there are other people waiting, is I think students, the folks that we've talked to, are really interested in charitable grants and the non-dilutive philanthropic gifts that they can receive from foundations.
Okay.
And we've seen some instances of where that's been done, in specific fields, like to advance medical research. There are foundations that give funds. The Gates Foundation does a fair amount of grant making to for-profit entities with very specific research purposes. We've seen it in media before. I think it's Rockefeller that's given a number of grants to the New York Times and other sorts of entities for specific kinds of journalistic undertakings. And then the third example that we've seen is sort of in partnership with the research institutions, where ventures that are taking on some novel piece of technology are able to secure sort of pass-through for-profit grant funds in partnership with professors or academic institutions, in exchange for publishing the results and kind of furthering future knowledge for the field. And so I think those are the sorts of use cases that my students are most interested in, but those additional named kind of mechanisms that you named for non-dilutive capital that's also not philanthropic are also really useful to think about. So I thank you for that.
Yeah, and thank you, Caleb, and I'd love to get a link to your article. The one thing I found, and maybe you're not finding this, is that when a for-profit entity goes to a foundation or a large donor for a donation for a for-profit entity, often it's get in the back of the line because we don't do this. And as you know, there is a great deal of competition for government and foundation grants. So is it the most expedited way? And what sorts of hoops will you have to jump through, and for how long, and how much effort to get that $100,000 grant or that $250,000 grant or even the $1 million grant? So those are some of the things that I look at is, time, effort, money that goes into getting the non-dilutive grants. And I think there's much quicker ways to get there.
Yeah, absolutely. They say nothing of reporting and compliance considerations on the back end too. Perfect.
Yeah.
Thank you so much for that.
Thank you, Caleb.
Before we get on to our next person, I'll just add that Impact Entrepreneur is a public benefit corporation and big advocates for kind of blended finance approaches and strategies. And we have a fiscal agent, nonprofit fiscal agent, Realize Impact. And we've had a number of philanthropic grants, gifts come through them. Ford Foundation went through them, that actually made our life and their life a lot easier to run it through a agency like Realize Impact rather than go through their normal Ford Foundation process. We've also had individuals and DAFs give through Realize Impact. It's actually been wonderful, and we'd love it a lot more to come through there. But Caleb, if you're interested in hearing, or your students are interested in hearing more about our experience, I'm happy to talk to you about that offline.
I appreciate that. Thank you.
Jay.
Hello, everybody. Greetings from New York City. My name is Jay. I have a vision of a business model that looks to be the change you'll want to see in terms of rebalancing and regenerative. But this is a content, entertainment based vision where I'm looking for collaborators and to share this equity from the ground floor from the get-go. So I don't really know how to find without money to hire, let's just say, social media and or supports of ambassadors. My goal is to really focus in on the DEI miss in the balance equation, to share equity of the vision from the get-go, to gather support, to create vision with momentum to do the things we want to do. And it's such a big vision, and I just don't know how to tackle this from the start.
Okay.
Does that make sense?
I think it does. Let me take a crack at it, and if we need to do follow on, we can. So first of all, if I'm understanding the question correctly, Jay, you're saying, look, I have a big vision for content and entertainment. I need to bring a lot of people on board, but I don't have money to pay them. And this is the typical run while tying your shoes issues that most entrepreneurs see. How do I actually get off the ground? And so I think that what I find is you really need to understand, especially as an impact entrepreneur, not only your business, your product market fit, who's also your competition in the case of content and entertainment. How will you market it? How will it grow? How will you get it distributed? What are the revenue models, et cetera? And really, really come down to a place of, here are my financials and here's my pitch deck at the very least, and to really be an expert in your market as it relates to your products or services. Once you've done that, I believe you can articulate to those that may be interested in joining you what the business is. Of course, it's an evolutionary process, and there you can say, this is the type of company, and literally, I would say, form a corporation if your exit or liquidity strategy is M&A or IPO or a reverse merger. If your model is based upon, I will never grow that big to get M&A'd with private equity or strategic corporate investor or acquirer, I will never get to an IPO. Then investors are saying, well, how do I get my
I'm not looking for investors. Sorry, Mark.
What?
I'm not looking for investors. I'm looking for.
No. And let me finish here for everybody else's edification. Because this is about forming the right entity. If your liquidity strategy to your investors is, I'm going to distribute profits, then I think an LLC is more appropriate. Now, once you have your clear understanding of what your enterprise is, what your impact mission is, what your market is, and how you are going to obtain or expand market share, then you form your entity. Once you have your entity, you have equity. Now you can go to the people you need, your core initial team, and say, I'm going to give you a boatload of equity and deferrals so that we can go out and create this and raise money. Now they become equity partners. However, one big mistake is, I'm just giving you equity, and a week later, these guys have dropped the ball. Now you've got somebody you've given a bunch of equity to. So you have to put mechanisms in place where through time and performance, they earn their equity. But that is one way to do it. Deferrals are another way to do it. Potentially, there are ways that you can bring people on board and say, look, I'm just putting you on my pitch deck, and we're signing a conditional contract, so that a lot of times when you go out to get financing, they say, well, how do we know that that person's going to stick around? Well, because we have this contract here that says you're going to stick around, and all we need is the funding in order to get them to stick around. So those are ways that I think you can get off the ground without having a lot of cash in the bank.
Thank you. Okay, we've got Jack, Marie, Ashley, and Kanan in the queue. Let's get through as many as we can in the next 10, 15 minutes, and then we'll have to break off no later than 1:15. Jack.
Thanks, Mark, for being here. Your words are music to my ears in terms of many questions I've had over the past, 30 years now. I've been doing telehealth. I'm a physician, and I wanted to find a way for us to be able to help out without having to travel necessarily around the world. And so we formed the Global Telehealth Network as a nonprofit now. And we're launching in Uganda and Kenya this coming week. I'll be flying there tomorrow morning, actually, to sign MOUs with the governments of both countries, setting up the nonprofit network that will be run within each of their countries with backup for international volunteers from around the world. So we started the nonprofit, and when I spent a year at Stanford 20 years ago in a fellowship on social entrepreneurship. There weren't many of those 20 years ago. And I was very discouraged because everybody I talked to about the idea of a hybrid business model or a tandem business model said, oh, no, you can't do that, Jack. IRS will put you in jail for conflict of interest. We'll come visit you on Saturdays, but we really wouldn't recommend trying to do that. Well, now, of course, we know you can do that. And so as soon as we've established the proof of concept, basically, with the nonprofit now, and we're getting some large numbers of patients seen, we intend to incorporate as a Delaware Public Benefit Corporation. We have the papers drawn up to do that. But my question is then, as we set up the PBC and we're looking for equity investors, we aren't likely to have a big exit. This is not something that's going to be acquired by private equity or a VC firm as a huge moneymaker. Now, there are large addressable markets that are not being served yet by the existing telehealth companies, even the very big ones like Teladoc. But we really believe we can generate enough revenue to feed some to the nonprofit as a consistent revenue stream to make it sustainable. I think we all know how hard it is to have a nonprofit be sustainable, and we think this tandem business model can do that. And I say tandem rather than hybrid because a hybrid usually means one owns the other. The nonprofit starts the for-profit or vice versa. We want them to be parallel with minor ownership by the nonprofit of the for-profit, so it's more attractive to equity investors. The question is, who is most likely to want to invest both early on and later on in such an enterprise?
Okay, I'm struggling a little bit with why you formed a PBC rather than an LLC and just put in your charter documents the protective provisions that you need to protect your mission and your purpose. Because with a PBC, generally you're looking at having that exit of an M&A or IPO, which you just told us you don't think it's going to get there. And if we wanted to distribute the monies or the profits of the organization back to the nonprofit and to investors, then an LLC structure, I think, would serve you better. As said in the beginning of this session, I'm not a big fan of L3Cs because of their lack of adoption and clarity. But I believe that you can put together an LLC and have provisions within the operating agreement and other documents and equity structures that preserve your mission while making distributions to your equity holders, which can include the nonprofit.
My impression of LLCs would be that you'd have a very limited number of investors. And the reason we were thinking about a PBC is that it allows more room for the little guy to invest.
I haven't found that. There's no limitation on the number of investors that you can have with an LLC, but you definitely want to have them be accredited investors. You have a limitation on the number of unaccredited investors in an LLC. And the question then becomes, how many investors do you need at some point in time? And this number is always changing. I believe it's now at 2,000 investors, but don't quote me on that, that then the SEC can force you to go public. So, you have to watch out for that floating number of investors. And then, you know, if you have to go public, then you're right. You'd have to be a corporation in order to go public, which means you have to transform your LLC into a corporation. But there you are going public, and now you've got your liquidity to your shareholders through an IPO. So, you know, my sense on this is start with an LLC, because then you can make distributions to your equity holders and you won't be subject to double taxation for dividend distributions.
Wow. I don't want to monopolize the time here. Time is short, but I'd love to talk to you a little more about this. The way to get in touch with you?
Yeah, I will put my email in the chat here.
Great. While you're doing that, let's see if we can get to Marie's and maybe one or two more. Marie?
Yes, thank you. I'm actually, hi. Thank you so much, Mark, and everyone who's said a little bit. Everything you've said, Mark, totally resonates with our theory of change. I work with Evolute 6. I'm based in Berlin. My co-founder is Graham Boyd, and for years we've been pioneering the Fair Shares Commons Incorporation. Have you heard of it?
What is it called?
The Fair Shares Commons.
I have not.
Okay, so well, it's part of my question, and my question's coming. So the Fair Shares Commons has already been approved as model articles in the UK and Wales, and it's accredited by the Financial Conduct Authority, which is the equivalent of the SEC in the States. It's basically incorporating the company as a commons with no concept of ownership or property. It's for profit. It can be a non-profit. There are multiple share classes for multiple stakeholder groups with different governance rights, voting rights, and shared profits and dividends rights. And we're building ecosystems of these startups incorporated as Fair Shares Commons, where they can share governance between them. And it's essentially what Richard Hansen was, I think, pointing at, is that you can get that context base and incorporate those little entities as commons companies that are stewarded by all. And you can build this into a limited company. I think in the States it's an LLC. You can build that into the bylaws. You can have multiple share classes, because essentially a share is not really ownership. And that's what's been causing the investor primacy is that investors treat the company as property. And basically that's how we see you can get the regenerative outcomes from the incorporated function that needs to be there. And so my question is, I would really love to connect with you and find out what form in the States, because I don't know the different forms of companies in the States or the jurisdictions. And it just seems like that your knowledge on legislation there and company structure is important to us. Check. Thank you.
I have my email in the chat, so please contact me, Marie. Also, you can find me in LinkedIn, and I'd be happy to connect with anybody on this call and see what I could do to help you out. And I know that we're running short on time, but maybe you could give us just a quick summary, Marie, of the core business model you have for the Fair Shares Commons and what it seeks to do by way of impact and purpose.
So there is shared governance across multiple stakeholder groups, not just investors. There is multiple capital incorporated because the different stakeholder groups are investing different capitals, not just financial capital, into a company, and that's how it's regenerated. Another name for a Fair Shares Commons is a agency-based incorporation models where everyone has their agency, things like all of the capital that's being put in, like that is shared and pooled. It could be IP, human capital, social relationship built, whatever, natural capital. And the way that all of these capitals have their rights and agency protected and enabled by the bylaws within the bylaws of the company in the way that it's incorporated, that is, those principles are upheld by the stewards who do not get any financial shares in the company.
I understand, I think. So it sounds to me like it's a cooperative of companies rather than natural persons. And that you're
Yeah,
taking
it can be.
Yeah, and that you're taking capital and defining it as I do. It could be capital, or I look at it as resources. You're taking a broad approach to what capital is, and it could be human resources, technology, money, market resources, services, products, whatever it is, and that these people contribute potentially some form of capital to Fair Shares, and that their contribution is recognized as equity. Is that correct?
That is, yeah, correct.
All right. So I think it's a very interesting model, and I'd love to explore that with you further. I think it's a cooperative model and potentially a collective bargaining arrangement that these people who join the Fair Shares world can, in fact, have the ability to have greater networking power, greater distribution power, potentially shared resources that they can trade, through and across their entities. So I'd love to explore that with you, and then we can determine what is the best way forward to actually capture the U.S. market and to get more people on board here.
Yeah, that would be so appreciated. Thank you so much, Mark. And just a note, it's an ecosystem of individuals and companies. There is membership into that ecosystem, and also there is a holding company, because we believe that it doesn't make sense to have disconnected investing in disconnected portfolios in different startups. That the only way is to basically have fractional profit pooling between the startups, where then there is a holding company
about an issue that I know millions of Americans are deeply concerned about.
Anyway,
and that is the horrible situation in Gaza today.
I think we need to put Jay on
As
mute.
many of you know, the Netanyahu government of Israel has killed
it's
more
okay.
than
We can
50,000
continue another time. Thank
we go.
you.
Thank you.
Okay, we're about to run out of time, but Keenan, you've been very patiently waiting. Why don't you come off mute and let's.
And thank you, Maria.
As you may know,
Yes,
the
yes.
Netanyahu government broke
Really quick.
the ceasefire,
Thank you, Mark, for hosting. Thank you, Mark, for hosting this. Not hosting, but thank you for being part of this. Lori, thank you, Lori. You're fantastic. I have your email address. I took it down out of the chat, mark@transformativecapital.com. I just made a connection on LinkedIn. I know that we do not want to go over time as we all are busy with schedules. Want to talk to you about my for-profit, nonprofit, but on the for-profit side, our established social impact affordable housing report. So I'll email you, and I've already sent you a LinkedIn connection.
Thank you. Appreciate that, Keenan.
Well, boy, we could have kept going for another hour or so. There's so many nuances to this conversation, but we do need to bring this to a close. Mark, thank you so much for being with us today. That was such a rich, informative conversation.
Thank you, Lori, and thank all of you for being here and for your questions. And I hope I was of value and of service to you. So thank you so much.